Let's get in a very special voice. Mark Matthews, Head of Research Asia at Julius Baer, joins in right now with his thoughts on all that's happening around the world. And Mark, good afternoon to you. Thank you so much. It's always a pleasure talking to you, and you know that. So thank you for taking the time out. And I hope all is well. But is all well with the world at a point of time when the US and Donald Trump are giving a deadline and changing it, saying that the new deadline is also negotiable, but at the same time launching tariffs and trade deals or some trade deals which are, well, slightly different than what they'd promised?
I'm fine, thank you, by the way, and it's an honor as always to be on the program. I think now the big beautiful bill is out of the way. He's come back to the tariffs, and the stock market is almost at an all-time high, so I think he probably feels more confident doing it than when it was just 1% away from becoming a bear market back in April. Now, Reuters says that the Europeans are not going to get sent one of these infamous letters, so it seems the letters are largely being sent out here to Asia, and the two countries where it matters the most are South Korea and Japan, because they export a lot to the United States. And so we'll see how it goes with both of them. Now, even if Donald Trump forces the Japanese to open their market to American rice, I doubt Japanese consumers will buy it in stores. So I don't really think it's a big deal if Japan gives a little on that. Like India, the agricultural sector is extremely sensitive. It is in all countries in the world. But I would just say that if you look at most other countries, including India, what percent of their economies are derived from goods exported to the United States, it is not large. So it is fairly large for South Korea and Japan, but for most other countries it's not. In India, I mean, it's something like, I don't know, 2% of GDP, very small. So I suspect that the tariffs are more noise than substance. And to me, the ultimate barometer of that is Walmart's share price. If the tariffs were really going to be a big deal, then I don't think Walmart's share price would be 5% below an all-time high, which is where it is today.
Very interesting take. So no one's taking this too seriously. The boy who cried wolf and the president who cried tariffs. Maybe that's what we're seeing till you have those final prices coming in. But Mark, I want to come back to that comment on India, because there's no letter, there's no deal yet though. What do you think, in your view, the outcome will be or is likely to be?
I don't know. There's talk of a mini deal and there's talk of an extension. But just to reiterate what I said earlier, I think it's mostly noise. This is not impactful for the Indian economy. And the noise could be bad, because if the government does allow genetically modified corn and soybean into India and opens up the dairy market and the automobile market, for sure the opposition would take advantage of that to say that the government's been weak. And there's no doubt the Americans are very competitive in agriculture, so they could take a dent out of that market for India. So, I mean, if the Americans end up putting a 26% tariff on exports of Indian goods to the United States, I would just say it doesn't really matter, because exports of goods to the United States are a very small part of India's GDP and certainly not what drives it.
Even the worst case scenario of 26% doesn't really matter. I mean, what we're learning is that those red lines on agriculture are unlikely to be crossed as far as the Indian negotiating team is concerned. Does that change at all the global view on the Indian markets? Trade deal or no trade deal?
No, I think it's irrelevant. The thing that moves the Indian market first and foremost is the earnings, which are forecast to be in the single digits for the impending results. But if we have a few outliers surprising to the upside, like in metals, I think we could even see double digit. And most certainly in the quarter beyond, we're going to move into double digit earnings, because both the central bank, which was very hawkish last year, and the government, which didn't spend much, those have done a 180-degree turn. The RBI, as we know, is dovish. And I think that will translate into credit growth rising into the teens again in the next few quarters, and that'll percolate through into the economy and earnings. And the government is spending again. So with that backdrop, I don't see much to take the Indian market down unless there's a big global correction, because it is a market that is sensitive to the world market. But on its own, I think it looks very good.
Got it. Mark, in terms of what happens to foreign flows in light of the fact that there has been some dollar weakness thus far, maybe there is more in store, and opposing views there, because some people believe that a lower dollar means that quantum of flows will actually go off, versus there being a view that de-dollarization and people wanting to diversify away from the US, which has been the first port of call for nearly the last 15 years, mean that emerging markets could actually get more flows over the course of the next 12 months. How do you think about this argument?
Well, I'm torn, because on the one hand, the positioning shows that there's extreme short positions in dollars. And historically, when we've reached such short positions, there has been a rise in the dollar. But on the other hand, there's a good reason for those shorts, which is the big, beautiful bill is going to require a lot more debt to finance the budget, and that will widen the deficit, which is currently at 7% of GDP. Now, historically, the US has run a deficit to GDP of about 2 to 3%, which is what most developed economies do. And so to keep it at 7%, and the Congressional Budget Office estimates it's going to go up to as high as 9% 10 years from now, would certainly mean a reduced credit rating and therefore a lower value in the dollar. So I'm kind of torn between the technicals and the fundamentals. I suppose the way I'd put it is that short term we could see a dollar rally simply because of those extreme positionings in the futures market, but longer term, the fundamentals do not bode well for the dollar.
Mark, did you have a chance, or have you looked at the recent SEBI verdict on Jane Street? And it's in some sense, it's a big one, and there have been some to and fro, so we do not know which way this will settle. But have you had a chance to look at it? What do you make of it? Any impact on trading volumes? Any other views that you may have on the development?
I would just say that this kind of thing happens once in a while, not just in India, but around the world. And because the investigation's ongoing, I don't think I can say any more.
Okay. So, from the Indian earnings perspective, Mark, you talked briefly about metals possibly being an outlier. How are you looking at conditions, say, for Indian IT, considering all of the uncertainty around America, pharma? Do you see this as being impacted at all?
If anything, beneficially, because the outlook for Indian IT was very gloomy just a couple of months ago. The online betting platforms were suggesting something like 70% probability of the US entering into a recession. Now that's down to about 20%. And apart from housing data, where you've got softness in house prices, generally speaking, I think the data in the US is still favorable. We saw that with the non-farm payrolls last week, which beat expectations. So I would say that the outlook for the US looks better, and that's not yet been reflected in commentary from the IT companies, but I would expect them to start to speak more positively about their operations in the US. So generally, I think it's looking better than it did a few months ago.
Okay, so that's an interesting view, because it's been very confusing on Indian IT, and here Mark Matthews comes and says it's looking better than before. What about some strong domestic plays like BFSI? If you're seeing the Indian economy grow at a steady clip, do you think that there are still pockets of growth in some of these segments?
I'm sorry, I don't have the local depth that would be required to answer the question, but I would go back to what I said earlier, that if credit growth does accelerate from around 9%, we think it's going to get to 12% around 2 or 3 quarters from now, then one obvious beneficiary of that is banks, right? So I think banks are a good domestic play.
Mark, in terms of all the developments that have happened thus far, what's your overarching stance? Let's say on India, from a 3-year view, one of the fastest growing economies per se, even now, large economies at least, as so far in the trade deals or the lack of it has come out unscathed. And as you said, it is noise because the overall impact is restricted to 2% of GDP. But let's assume we kind of protect that, do more. India does more trade deals as well as FTAs with other geographies as well, and continues to grow at this 6.5%, 7%, which is the base case for most people. Does it stand to get flows over the course of the next 2 or 3 years, or do the flows remain at best unpredictable or anemic, as have been now for the last 2-3 years, wherein for a period they come in and then for a period there's just a consistent outflow?
Yes, I think it stands to get inflows. Generally speaking, the emerging market asset class has been a terrible place to invest over the last 10, 20, 30 years. Big opportunity cost in being and invested in emerging markets. One of the very few outliers is India, and so it has a proven track record of providing returns, even dollarized, to overseas investors that you can't find in Southeast Asia or Latin America or even in China or South Korea. Now, I would say, having mentioned China, that one thing that is interesting to watch is the gradual transformation in policy in China, which had been quite against the private sector there. The big thing since 2022 has been so-called common prosperity, which means a redistribution of wealth from rich people to everybody. Of course, the market doesn't like that. Now, it seems that over the last year, there's multiple signs that they're moving back toward being friendlier toward the private sector. I think one reason is they recognize the technology sector in China offers so many products and services that are truly globally competitive, in some cases superior, from artificial intelligence to smartphones to semiconductors to electric vehicles. So why be mean to the companies that do those things? So anyway, I don't want to ramble, but I think you could get better news in China over the next few months, year. That would make people more disposed to investing in it again. Could take some of the shine off India, but I still think if you're talking on a 3-year view, that India is the best emerging market in the world.
Thank you so much, Mark. Always a pleasure speaking with you. We love it when you join us right here on NDTV Profit.